our next guest says there's something happening in the market we haven't seen since the financial crisis. It could be a sign of the next recession. Morgan Stanley chief U.S. Equity strategist Mike Wilson, who's always in a bad mood. We're back to 3005.
Here we go.
We're back to the high end. I've seen this before. I've talked to you about it before. Next thing I know, you're on a show and I'm going, wow, it's at 2,800. Maybe you're going to. I mean, do you ever waver? You're still talking.
Well, not yet. I mean,
talking about 2,700 still on the S&P.
We're talking about a range, basically, right?
We're back to the high end.
Correct. Now, here's what's changed, or I think might be changing, Joe. Okay. Last time we were together on your other show, we were talking about the range, and we're at the low end.
Right.
And now we're back at the high end. And
I know.
So what's happening?
See, now I think you're bad again.
I
thought you were. I thought he was a genius last time he was on. Now I think you're wrong again.
So look, I think what's going on is that it's not the Fed as much as it was in July. Now it's about trade. And so we got hope that the trade thing's going on. But we really got to go back a year and a half, right? This has been going on now for 18 months, right? People are finally talking about a recession, right, in the survey you just mentioned earlier, and people are actually mentioning it on shows like this. That's been going on for 12 to 18 months. The time to make the slowdown call, the recession call, was a year ago, right? That's why utilities have killed it. That's why bonds have killed it. That's why staples have killed it, right? That's why defensive growth stocks have killed it. And that trade has basically played out. That's what the momentum crash was all about, right? We basically priced a recession for the most part in August in a lot of these markets. Rates at 143, that could be the low. Okay, utilities, 1,000 basis points of relative outperformance in 1 month. It's extreme. Cyclical is being thrown away. So I don't think it's all going to be in one flush, but this could be what we call a kickoff move, where the market is now starting to think about maybe we're going to have a recession, but we're close enough to the end of this cycle, I can look through it. Right? And that's why they want to buy banks. That's why
it's going to be the craziest recession we've ever had if we stay under 4% for unemployment, though.
Well, no, that's not going to happen. Okay?
All right, so we're headed back to where? 5, 6?
If you actually have a recession, which it's not a fait accompli, but if you have a recession, unemployment will go back to 5.5%, 6%. But the market typically prices that well in advance. That's what's gone on in the last 12 to 18 months. Now, we don't know if we're going to have a full-blown recession. Our call is like a 30 to 40% chance. But if we start to tip over, I think you'll get another growth scare. But we don't necessarily have to go through 2,700 on the Saudi, right? It's going to be a rotation. That will be a signal to buy all these early cycle stocks.
It's weird when suddenly then you see the Saudi oil fields, half of them get shut down. Suddenly we get a spike in oil and all these things that you're saying, well, why are we going to have a recession? There's nothing on the forecast. And then all of a sudden you got a reason, or perhaps a reason, or part of a reason.
As you know, I mean, when you get you always get an oil spike before the end of the cycle. So this could end up being kind of that final tipping point because it will raise prices for companies like FedEx, who obviously missed today,
about that,
and also, consumers, quite frankly, at the pump.
But Mike, what do you think about the breadth of the market? Despite, first of all, I think your caution, and you've been very consistent with this, and I think you've been right to be consistent with it. But to the extent that the market over the last 3 to 4 weeks has given you the kind of breadth that we've been looking for from this market for a long time, what does that do for you?
No, two things. So first of all, the curve is re-steepening from the back end, very constructive. Okay, some of that's technical, but I have to acknowledge that. The financials working, okay? Some of these other cyclical groups are starting to work. I think that's a good first sign. I don't think it's going to be a straight line up, though, right? Typically, if you go back and look at recessions in the past, 1990 or the 2001 recession, very mild, okay? It was a chop. You get months where you think, oh my God, I got to buy all the cyclicals, and then they give it up again. And it's a chop because unemployment will go up for the next year and a half, 2 years, if there's a recession. And it looks more and more like that's where we're headed.
I'll tell you, I'd sign on for 5.5, 6 if that's the worst we get in the next recession. I'd take that. I'd agree to that right now.
But that's a typical mild recession.
Yeah. You mean in terms of from the lows in unemployment?
That's right.
Because 5.5 to 6 almost a couple of years ago we thought that was full employment or close.
That's right. But that's a typical mild.
I'm going to give you a chance. Do you want to make?
Do you feel lucky?
Do you want to make 3,000 the new low end of your trading range and put 3,250 on the high end of your trade? You can do that right now. You can do that right now if you want. If you want to do that, you can do it. We'll let you do that now.
Well,
this is like deal or no deal.
The SEC might come after me. But look, what I would tell you is that
you don't want to do that. You still got 2,700.
We have been using 2,700, which, by the way, is up from our old base bear case of 2,400 a year ago, which we hit in December. So we've been moving our targets higher on the low end. I think it's a little premature to say 3,000 isn't still your cap. 3,050, okay, the old highs. No, I think it's premature to say 3,200 is in sights now because the Fed still is behind the curve. Let's see what they do tomorrow. Let's see what actually happens in October with this trade mini deal. We don't know what's really going on there. And quite frankly, the tariffs that went in September, they're on. There's been really no discussion about rolling those back. There's been talk about delaying the 5% increase. And so I think that 10% tariff still has to flow through to the real economy.
So you like this show or the? I mean, would you rather get up early? Would you rather come up? It doesn't matter.
You are, Joe. I'm coming on that.
It's me. It's really not the show. It doesn't matter which show. It's me.
Right.
Thank you, Mike. Thank you. Goodbye. Thank you. They're saying that to me. Thank you, Mike Wilson. Hi. Well, we got to go. I think. Oh, we're going to trade it.
I think we should trade it. Why not?
You want to start? You always ready.
I'm not. I've never been shy, Joe. So look, we have a case here where I think the Fed tomorrow has had data over the last 30 days, whether it was the ISM, whether it was the industrial production number that was out this morning, whether it was some of those payroll numbers, that is going to the dissension that we've seen within the Fed that came out in the Fed minutes at least. This is a Fed that is, I don't think, ready to be proactive, and therefore for a market in the short term, despite all the positive kind of dynamics with semis finishing on the highs, EM closes above the 50. Everything you wanted to see on terms of risk has snapped back. I have trouble in terms of my week to 2 week trading range, seeing that we can get much out of our way here.
Tim, I think at the end of the day, though, the policy rate in the U.S. is still the highest around the world, right? So when we look at right now, money growth, M2 running 8%, nominal growth running 4%. How bearish can you be on risk assets when there's excess money out there to go into stocks, right?
And I'm not.
And then I think also let's not discount the stimulative effect of lower bond yields over a 12-month period. Bond yields peaked about a year ago, about 326. We've taken 175 basis points out of yields. There's a stimulative effect to that. I think it's why the surprise data is starting to bottom. I think it's why those cyclicals act better.
BK, if it's, is there a way you can bring some Bitcoin into that? I don't think we can.
I can bring Bitcoin into a lot of things. I don't think you have to necessarily bring it in tomorrow. We are at the high end of the range. So I don't think as an equity investor, do you need to go out and just go 100% into the market at the high end of the range? No, not at all. I think you wait for some kind of pullback. And I think there is the risk, as Pete mentioned, that the Fed kind of has a miscommunication problem. And the market sells off. And maybe if you're bullish, then you buy it.
And to that point, that's what you're always looking for, right, is those opportunities where we oversell. When we overjumped the other day in oil, all of the panic to see oil jump over 20%, at least early in the overnight trading, and then over 10%, Joe. Yep. Look at how fast it's already retreated back underneath $60. I mean, it's amazing, right? So the speed and the velocity of what we're seeing and all of this rotational stuff is happening so much faster than anybody even can comprehend. There are great opportunities daily in this market.